is the Fed in a weakening economy and maybe even a financial crisis? Who knows what might blow up? Because interest rates, they're almost 5% now, and they're going to be 5% pretty soon. We were at zero. So that's a huge change. You built an economy around 0% rates. It can't function at 5%. The whole thing has to implode, which is a good thing because we had a phony economy and that needs to implode. But when it does, it obviously creates a lot of problems. A lot of people are going to lose a lot of money. And that's not going to be something that the government is going to want to sit by and just, watch it play out. They never do. They always feel compelled to intervene and do something, even if what they do makes everything worse.
Peter David Schiff is an American stockbroker, financial commentator, and radio personality. He is the CEO and chief global strategist of Euro-Pacific Capital Incorporated. Peter has thrown a lot of comments recently regarding the U.S. financial market and the Fed, stating that people who think that we've seen the worst of inflation are wrong, and that the surge in credit card debt proves the labor market is weak, and Ronald Reagan's tax system was the closest we've been to a flat tax since 1913. He also said that Biden is putting America in a much more vulnerable position with the continued selling of strategic oil reserves, and that replacing full-time jobs with part-time jobs is not a sign of a strong labor market. At the same time, some central banks around the world are pumping liquidity into their markets, while Fed continues to drain liquidity out of its market. This could mean that all of the efforts by Western banks to limit the money supply will be canceled out by Asian economies injecting more liquidity into theirs. Peter also mentioned that gold is becoming increasingly popular as a hedge against sanctions is because of the increasing weaponization of currencies around the world. Central banks around the world are increasingly using gold as a way to reduce their dependence on other currencies. This has led to increased purchases by central banks around the world to reduce their reliance on those currencies. As long as geopolitical events continue moving in this direction, gold prices could potentially continue rising. We are seeing an accelerated depreciation of the dollar, something that could have a negative impact on inflation figures in the future. The Fed is getting close to shifting its approach, but it's still too early to say for certain what will happen if there are sudden increases in inflation data along with historically low unemployment levels. Let us now go into the video. Make sure to hit the like button, subscribe, and turn on notifications.
The way the government measures prices and what actually happens to prices are two different things. So the real increase in prices is much greater than what is being officially reported by the government. But I think that, you had this initial spike in a lot of prices, and then the Fed started hiking rates, and that had an impact on the dollar. It had an impact on commodities. You saw commodity prices come down, particularly oil prices, and higher interest rates had an impact in housing and other areas of the economy. And so you got some temporary easing of the inflationary pressures. Also, U.S. GDP got a boost from the strength of the dollar because the initial result of higher rates was a stronger dollar. That brought down the cost of our imports. That helped keep commodity prices down. That also helped boost the GDP numbers. But I think all that is going to reverse. We saw a big drop in the dollar in the fourth quarter. Dollar weakness is continuing so far in 2023. I expect it to accelerate. And that's going to worsen the trade deficits. And that's going to help push commodity prices to new highs. And all of that's going to put renewed upward pressure on the inflation numbers. But of course, they never should have had a 2% target. There's no reason for inflation to be 2%. It's not like if it's 1%, that's a problem and it needs to be higher. The only problem with 1% is that it's not zero. Zero inflation is better than 1%. So if inflation is 1%, it's not that it needs to be 2%. And in fact, if you have falling prices, if prices are going down by 1%, there's no need to force them higher. I mean, we all benefit from falling prices. I mean, everybody wants to buy stuff for less money. There's nothing wrong with prices going down. That's how standards of living go up, right? The things that you want to buy are less expensive. I mean, everybody wants to buy stuff for less money. Sometimes if you can't afford something, you have to wait until the price comes down and then you can afford to buy it. I mean, so falling prices creates demand and it lifts living standards, and that's what we need. But, the Fed concocted this BS that we needed 2% inflation. We didn't. We needed it like a hole in the head. But the problem is now they've created so much inflation under the guise of targeting 2% that they have no way of even bringing it back down to 2%. But I have no idea what the annual rate is going to be. But whatever it is, it will not be reported accurately because they're going to continuously monkey around with the CPI. And so it's never going to honestly reflect how much prices are going up. In fact, all the years that the Fed claimed we had less than 2% inflation, my guess it was at least double, if not triple 2%. Central banks around the world are concerned about the weaponization of the US dollar and the SWIFT system. They saw what happened to Russia and what is happening to Russia now, and they don't want that to happen to them. And so we have created another reason for the world to de-dollarize. I mean, they had plenty of reasons to do it anyway, but we were foolish enough to give them even more because America benefits dramatically from the dollar's reserve status. And when we lose that status, and we will, it's a matter of time, it's going to be a huge wake-up call because it's going to mean a dramatic decline in the standard of living of just about every American. And so, it's a mistake to accelerate that process. I mean, if you're a politician, if you really understood it, but that's what we've done. And so, yeah, I'm sure that these foreign central banks are buying more gold for that reason. And also, they think the dollar is going to lose value and they want to have a more stable store of value as a reserve asset for their own currencies. And so I think that's going to continue, especially when the world kind of wakes up to the reality that 2% inflation is a thing of the past, and that the inflation rate is going to be much higher than that, at least even the way the government measures it. And that's going to result in a revaluation or repricing of the dollar and a repricing of gold. I mean, the dollar is worth a lot less in a higher inflation environment, especially if interest rates will be perpetually negative, and gold is worth a lot more. And when the markets come to terms with that, you're going to see the adjustment.
The Federal Reserve's balance sheet reduction has had an impact on the economy, and it's not just the stock market that's been hit. The balance sheet reduction has also had a significant impact on wages and jobs. The Fed has been reducing its balance sheet by buying back government bonds, which causes interest rates to go down. This artificial low interest rate policy was put in place by the Federal Reserve for more than a decade, and it has had a significant impact on the economy. Let us listen to what Peter has to say about the job market.
Right now, what's creating all this noise in the jobs numbers are all the part-time jobs that people are being forced to take on because they can't get by on the income from their full-time job. Or some people may have had a couple of part-time jobs and they needed to take a third part-time job. So that's going on right now, because if you look at the data over the last 10 months, we've actually lost full-time jobs. There are fewer people that have full-time jobs now than had them 10 months ago, but you have over 1.5 million more people that now have part-time jobs. Now, some of those people still have their full-time job. They're just working another job. Now, why would somebody who has a full-time job go out and get a second job? Well, it's because they can't afford to pay the bills with the salary from their full-time job. So they need to moonlight. And so that's what's going on. And that's really what is impacting these numbers. As far as why the unemployment number is so low, I know a lot of people aren't being counted as unemployed. And I know a lot of people a couple of years ago made the decision to be self-employed. They got into the gig economy, whether they're driving Ubers or DoorDash or something like that. And so they can never be fired. Once you decide that you're just going to work for yourself, you can't fire yourself, so you can never really be unemployed. So I think there's a lot of noise in these numbers. I think the labor market is considerably weaker than the Fed believes or the market believes. But at some point, all these layoffs that we're getting, and look, more layoffs were announced today. Look at a firm that buy now, pay later company, stock down 20% today, laying off, I forget, a quarter of their workforce. I mean, who didn't see that one coming? I talked about the nonsense of these buy now, pay later companies when they were, all the rage. But one of the reasons that consumers were able to spend money is because they didn't have to pay. They just got stuff for free and they thought they'd pay later. But of course, they're going to pay never. And that's going to be the problem for a lot of these companies because, they fronted the money and now they're not going to get it from their customers. But you're getting more and more layoffs, from tech companies. You're going to see a lot more layoffs in, crypto and blockchain. All these companies, hired people. I mean, all these guys are going to lose their jobs. The rate hikes that we've already had are taking a toll on the economy right now. And we're just beginning to see the effects. And it's going to get a lot worse. Remember, it's only been a year, not even, since the Fed raised rates for the first time, right? So, there is a lag. between the increase of rates and the effect on the economy. And so we're just kind of catching up to those effects, but they're going to be enormous in all segments of the economy. I mean, not just the stock market and the real estate market, but you have an American economy that's based on cheap money. I mean, that's what it was running on for more than a decade. Well, now it's time to pay the piper, and everybody's broke. You can't pay the piper. So that's bad news for the piper, who thought he was going to get paid, but it's everybody else too, because now they can't get any more free music or entertainment. So there's a huge day of reckoning here that we're just on the cusp of.
According to Peter, the Fed's $4.5 trillion in assets are now worth about $2.7 trillion, which is a 50% decrease from where it was when it started this policy of reducing its balance sheet back in 2008. Although this is only a $500 billion reduction from its peak, it's still taking a long time for this debt to be deflationary, meaning that the debt will eventually be repaid with less money each year than what was originally borrowed. This means that people who have been relying on low interest rates to help them save for their retirement or invest their money have now hit a roadblock. Those rates are now expected to stay low for an extended period, even after the balance sheet reduction is done. Peter Schiff has pointed out that it is time for the effects of unrealistic monetary policies and Fed rate hikes to add its toil, and the result of this would be painful to so many people. In his recent podcast, he also bashes the Fed heavily and also blames Biden for putting America in the mess that it is in right now. What do you think of Peter Schiff's view regarding the market outlook? Let us know your thoughts in the comment section below. Also, do not forget to give us a like, subscribe, and turn on notifications for future videos. Thanks for watching.